Hi everyone, good afternoon. My name's Luke and thank you all for joining our webinar today where we talk about preparing for your self-assessment, quite aptly timed as well as we head into the spooky season. So hopefully this doesn't burden your spirits as we head in, and we can get a lot of your questions and queries answered to give you a bit of peace of mind so you can enjoy the season. Today I am joined by Katie and Michael. Now I'll give you a short and sweet introduction for myself first, and then I'll pass you over for their intros. So I've been with Crunch now for just coming up to about 8 years. I'm one of 2 client experience specialists where I deal with all things to do with the software. You may have seen some of our walkthrough videos and YouTube content as well. And yeah, you're in safe hands. We have a collective experience here. We were talking about it earlier of just under 30 years between all 3 of us, actually. So you're in safe hands. So I will pass you over to Katie first of all as well.
Hello. Yeah, I am the other client experience specialist at Crunch. I've been with the company for about 11 years, so I've seen it all, done it all, so hopefully can help out and answer some questions today. Michael?
Brilliant.
Yep. Thanks, Katie. Yes, I'm Michael. I'm the regulatory and technical manager in Crunch. I've been with the company for almost 7 years now. So yeah, one of the senior accountants we have in Crunch.
Brilliant. Brilliant. Thank you both. So yeah, if my math serves me well, it is just under 30 years. So yeah, you're in safe hands with the 3 of us. We will, just as a heads up, obviously we can see you all commenting, which is fantastic. Please keep up the engagement with us. If you do have questions as we go through, Katie's going to do her absolute best to answer them for you as we progress. And some of you may have seen earlier, we have got the ability to put questions on display as well, so that you'll all be aware of the question being asked, so that we can, answer those and get through them together. Now, what we're actually going to cover today then, very, very simply is, first of all, what is a self-assessment? Now, for the uninitiated, we want to do this we're right at the start, basically. So simply, what is a self-assessment? Of course, some of you will already be aware what a self-assessment is, but we want to make sure that we cover all experience levels from beginner to the more advanced a bit later. So starting with what is a self-assessment, we'll then discuss the important financial and filing dates that everyone should be aware of, whether you're experienced or not. A really simple one, actually. Do you even need to file one? We get this question quite a lot as well. You also need to be sure that you're registered for a self-assessment, so we'll cover that as well. We'll discuss the more complex areas of self-assessment, so the info that needs to be included on them. And then we'll talk about how you can start preparing to file it as well. And this will be things like tax efficiency. Have you claimed everything that you can? Are you ensuring that you're including everything that you can to get the tax relief that you need to? And then finally, how is it that Crunch helps our clients as well getting through self-assessment? So without any further delay, I think we're pretty good to crack on. Anything further from you, Katie or Michael?
I think we're good to go.
Perfect. All right then. So we will kick off simply with, what is a self-assessment? Now, self-assessment is a way of reporting income to HMRC, and this is for both limited companies and sole traders. Now, there are some variations to what is reported to HMRC depending on your operating type. So most of us will be aware through simply being employed at some stage that most of that tax is actually deducted from your pay slips, so from your salary, and that's typically known as tax deducted at source. So this will be things like PAYE income. Okay. Now, the things that self-assessment cover is basically income that isn't under PAYE. So this is what's called undeclared. Okay. Now, you declare it by completing your self-assessment. Now, when you file self-assessment, you actually have to include all income, whether it's PAYE or non-PAYE. The real difference here is that the PAYE income, you're not going to be double taxed on that, because as I mentioned a moment ago, that gets taken from your pay slips. It's just a way of keeping HMRC in the know, basically. They want to know what you're earning through PAYE so that they know it's been taxed, so they don't touch that. But it's the non-PAYE stuff that they're super interested in, because obviously they want a slice of that pie. Now, Michael, I'm going to point over to you here. Do you want to explain some of the essential differences between limited? I know that we've got them in the columns underneath, but we'll hear it from the expert. If you can go into a bit more detail for us on those key differences.
Yeah. So what basically happens is that once you're a limited company, imagine you're a limited company director, they would obviously be having their income tax and then employee NI and the rights being deducted whilst their payroll is being done. But what also happens is that because they have dividend income, they need to file a self-assessment, declare the dividend income, and then also their PAYE income. The reason, I mean, you mentioned that it's already been taxed, but the reason they need to declare the income they've already earned through salary, which HMRC already knows. Because if you are doing what we call an RTI submission, that means on a monthly basis, or whether you pay your employees fortnightly or whatever it is, a report is sent to HMRC saying that, okay, we've paid this person £1,000, we've deducted X amount in, what do you call it, income tax, NI and the rest. So HMRC has already got this record. But the crucial reason they need to include that information as well on their tax return is to do with their recomputation of their taxes. Because when your payroll is being filed, you are given personal allowance. Okay, and the personal allowance currently is 12,570. So you can imagine someone who doesn't declare their payroll income on their self-assessment, they will be awarded an extra 12,570 on there. So it's like one individual gets two lots of the 12,570. That is why, although you may have already paid taxes on it, you should declare the combined income. Okay.
That makes sense. That makes sense. So effectively then, like you've just quite rightly said, it's a way of HMRC knowing whether you've used certain allowances so that you're taxed correctly, rather than being in for a nasty shock later with them trying to maybe get more tax back off you than you anticipated.
Yeah, we come across this all the time where clients, I mean, those who don't really know, would just tell you about, let's just say they've got sole trade income. They believe they've already paid taxes for their salary and the rest, so they wouldn't tell you about it. You file the self-assessment, then HMRC writes to them and basically says it's been done wrongly. You haven't told us about this income, and then we are recomputing. So most clients think that we don't need to declare this income because I've already paid taxes on it. Best policy is declare everything, and basically the accountant will decide what goes in and what doesn't go in. Okay. Rather than you basically not declaring and then
shock. I mean,
I'm just going to jump in with a quick question, if that's all right. We've got a good one coming from Julie. Do you still need to declare your dividends if you've taken below the allowance threshold?
Yes, it's always good just to at least give that information to an accountant, let them put it on. Funnily enough, I had one question related to something quite similar from a client this morning, where we prepared a self-assessments. They, in their case, had capital gains. Now, the capital gains amount was less than the capital gains allowance. So because they had no tax to pay, we still put it on the system, but because there was no tax to pay, it excluded it as a line item on their tax return. The client was worried about it. So I went back and then explained to the client. So always good to basically declare the information, we put it on. Whether it goes through or not is dependent on whether you have taxes to pay or not. Sometimes it will just be there as a line item, but you have no tax to pay.
Perfect. I suppose in a really short and sweet way of saying this is going back to your point about just declare everything. I don't know about you, but I would, in some ways, rather overpay my tax and then get it back than underpay it and then be at a loss a bit later with a nasty surprise. You know, in an ideal world, you wouldn't make overpayments, of course, but I suppose, I don't know if everyone here shares the same thing. I would rather be nicely surprised by an overpayment and a refund than an underpayment and perhaps not even have that money available any longer.
Yeah, plus interest as well.
That's true, actually. they do love their interest, don't they? So yeah,
2.5% now.
Oh, is it? Okay.
Yeah.
Right. So okay, well, that was a really good question, Julie. Do you have any others, Katie, you want to pop up on screen for us before we move on to the next section?
The other questions are fairly similar. So we've got one asking, if you're a private landlord, are you also still considered as a sole trader?
Yes. Rent. If you're a private landlord, what you get is basically a rental income. That income hasn't been declared to HMRC. So the self-assessment is the only opportunity for you to declare that. There are obviously some who use agents, and then the agents basically withhold taxes and then pay to HMRC, but you still need to file a self-assessment to declare your rental income, the expenses you've got, and then you then pay the taxes that you have to pay.
Lovely. Perfect. Alrighty, let's move on. I can see a number of the questions coming here now are quite specific to you know, PAYE, dividends. We will cover these, guys, so bear with us and we'll get through to them as quick as we can. So next up is simply, what is the financial year? Now there is often some confusion here between the financial year, particularly if you're a limited company, between the financial year and a company year. Now, a financial year is applicable to absolutely everybody in terms of personal tax. So the financial year operates between the 6th and the 5th of April every single year. So this accounts for things like your income. So salary, dividends. For sole traders, this will actually be, in some ways, your business year. Now, the difference between limited and sole traders is all of your income is accounted for in the financial tax year, which is, as we just said, the 6th to the 5th. The key difference with the limited, though, is you will also have a company year. Now, that is totally separate from this financial tax year. Company year, to keep it short, is everything to do with your business income. Okay, whereas the financial tax year will be everything to do with your personal. So the key date here, like I say, is the 6th to the 5th, and that's a revolving door, so it's the same every single year. And the due date for filing a self-assessment is also the same on the 31st of January. So as you can see in our example, the previous year, which is what we're talking about now, we're getting you prepared to file in January of next year, was the 6th of April to the 5th of April, but you do the filing in the January following. Okay. Now, if we look at the current tax year, which is what we're now in, it's the 6th of April this year to the 5th of April next year, which then becomes due in January 25. Michael, Katie, did you want to add anything further to that in terms of differences between maybe company year, financial year, anything else they need to consider with these dates?
The only thing to add on there is that the company year, usually if you look on Companies House, if you're a limited company director, you might see the company year they are expecting you to file for. So assuming you were incorporated, let's say today, then usually they would expect your company year to run from, let's say today, which is the 5th of October 23, to next year, October, end of October next year, and that might be your company year. But then also with a company year as well, when you're filing your company's tax return, there's a different type of financial year for that, which basically would group the company's profits into different financial years as well. That doesn't run from the 6th to the 5th of April. That starts on the 1st of April and then it runs to the 31st of March. And those dates are set for like, you know, when a chancellor would announce that maybe corporation tax is rising to, let's say, 25% and the rest, that would have started on the 1st of April, let's say this year, and it would run to the 31st of March next year. And then the chancellor might announce that maybe we've made a mistake, so we are bringing it back down. And then, yeah, so there's a different financial year as well, which is for limited company, but that doesn't apply to the individual. The individual's one is always, as you said, from the 6th to the 5th of April.
Perfect. Excellent. Right. Do we have any questions on this topic, Katie, that you want to put up for us here? Just having a quick nosy through them.
Yeah, we've got a lot coming in and kind of trying to keep up with all.
That's fine. I mean, I think what we'll do is we'll have a report of all your questions afterwards as well anyway. So certainly any of those that do get missed, don't panic. We'll do our absolute best to reach out to you and answer them as best we can. Let's see.
I think just for anyone that is unsure if they need to file based on when they started work and receive payments, one of the best things, which I think we'll talk about later as well, is just to have a look at HMRC's online tool, where you can just put in what your situation has been, and it will tell you if you're actually required to file for that year. So that's a really helpful one. I don't know if we've got a link to it on these slides, but
yeah.
If not, we can get a link out to everyone.
Yeah, we certainly do. I mean, when we get to the do you need to file one section, as Katie mentioned, there is a checker that you can use with HMRC online. So if let's take an example that you're in a scenario where you've earned something in March. So let's say you earn a little bit of cash at the end of March. Do you then need to complete the self-assessment? You know, even if that was the only bit of self-employed income you earned, that is one of those sort of strange scenarios where it's like, well, do I need to do a full year's worth of self-assessment for one undeclared income? We will cover that as well. But as Katie said, you can also use HMRC's online checker if you want to as well. One final thing at the very bottom, just as a heads up to you all, there are some quite big changes actually coming into effect, penciled in for April 2026. Now, originally, this was penciled in for 2024, but they've pushed it back. And this is basically HMRC changing the frequency at which a self-assessment is completed. So at the moment, you just report it to them once a year, which is what we're talking about now. There are plans actually to do quarterly self-assessments, as well as sort of overarching one final self-assessment to confirm it. Michael, I don't know if you have any more details on this that you want to go in. I think that's more or less what we know for now.
Yeah. The only thing is that they started a pilot so far, and I think they might be getting some good responses from those who are basically participating in it, but they've still decided to push it back because I think most people, or I mean, you could tell there's lots going on now, so they really don't want to push people over the edge with it. So yeah, it would come in, but it's an easy way for them to make easy money, or let's say know how much revenue will be coming in. So definitely they are going to do it, but they've just given us a bit more time now.
Okay. I mean, I think we can all make assumptions as to why they're doing this, can't we? But we won't go too deep down that rabbit hole. So let's crack on then. So the next up is actually leading nicely into what we were just discussing. Do you actually need to file one? Now, this is a question we hear all the time. And, you know, for example, going back to my previous example of you've received a payment in March, do you then need to complete a full year's worth of self-assessment? Now, it's situations like that are quite niche, but something like that is going to be down to HMRC's discretion. As painful as it is, we've all done it. You will need to talk to HMRC, I'm afraid, and get their input on whether you do or don't need to do one. Now, there are some fairly common situations which we've listed here. So, for example, if you haven't had any income this year, do you actually still need to tell them? The short and sweet answer is yes. If you're listed as being self-employed, if you're registered with HMRC as self-employed, as either a director or a sole trader, even if you have nothing to report, they still actually want to know about it. So yeah, I guess, again, tying back to Michael's point earlier about just declare everything, and that's true even if you don't have technically anything to declare. They want to know about it. You know, have you earned anything? Are they getting anything from it? That's really what it boils down to. Michael, anything further from you on that particular point?
No, nothing to add to that one.
Okay, perfect. Another question that we get as well is, you could just be a shareholder, right? And this applies for limited companies, of course. So if you are just a shareholder, you know, you're not being paid under salary, you haven't got PAYE income, you don't, you know, technically do work for the business, you hold shares in the business. The answer again is yes. Shareholders will have the ability to take dividends, which is a form of undeclared income, going back to what I said at the beginning, and it has to be reported. Again, similar to the above, even if you don't earn dividends in that year, you still have to complete a self-assessment with HMRC, even if it's just putting a 0 on the self-assessment in that case.
Yeah, look, a quick point to add to this shareholder one there. Sometimes when your dividends, let's just say, are below 10,000, I believe, off the top of my head, and you aren't registered as needing to file self-assessment, you could basically be exempt from filing. But I would recommend that they use the tool we have in here to basically notify HMRC, because usually when you go in there, it will tell you whether you need to file or not. If you don't need to file, it might still require you to probably put in a call to HMRC. They obviously have that conversation with you over the phone, and then they basically give you the okay not to file it. So it's always good to have some kind of what do you call it, evidence of you making an attempt and then being told by HMRC, don't file, okay, rather than simply not filing. So if you've got a worst of two options, you'll simply just file, declare the small dividends, and then basically have no taxes to pay, or you speak to them and then they basically say no need to file, and then that's it.
Okay, it's a very, very good point. I'm sure there's a bunch of us in here that have had phone calls with HMRC from being told one thing to then speak to them again and be told something entirely different. So you are absolutely right. It's always worth getting something in writing, you know, even if it's just a case of jotting down the time of the call and the name of the person you spoke to as a reference point. You know, I've had it myself. I get told one thing and then you call back an hour or so later and it's something entirely different again. So you're kind of in limbo there over who's who. I mean, I often do a thing where I'll call a third time and I think, well, if someone gives me one answer the same as the previous person, I'll go with that. It gets even more confusing when the third person gives you a different answer again. So it can be like that sometimes. So yes, do keep evidence of your you know, logs basically of when you've spoken to them and what they've said. Now for the last question, I'm going to defer to Katie here, because Katie has expertise with closing businesses, non-trading statuses, and the simple question is, if you're not trading, do you need to do it as well?
Yeah, it's one that we do get asked an awful lot, 'cause you could be not trading for a couple of different reasons. So you could be not trading because you're closing your business down. So if you're a limited company and you've decided to shut the limited company down, at what point do you then need to stop filing? Or if you are putting your company into a dormant period, do you still need to continue filing them? Quite simply, for most cases, if you are just taking a bit of a hiatus from working, but you are still registered, you will continue to file. It will just be usually a nil return. So quite simple to prepare. If you are a limited company and you are shutting your business down completely, you will still need to file a final self-assessment. And at that point, once you've done your final one, you can deregister yourself from HMRC, as long as you haven't got any other reasons why you would need to stay registered. That kind of sums it up as concisely as I think we possibly can there.
Yeah, simple.
Anything else to add on that, Michael, from an accountant's perspective?
No, nothing much.
Perfect. Alrighty. And as we mentioned earlier, you've got the link here, and we are going to send these slides out to you all, so you'll be able to, refer back to these and use the links on here that we've provided. So moving on then to, do you need to register for a self-assessment? Now, short answer is yes. If you've never done one before and you are trading, you actually do have to go online to HMRC and register directly with them and report that you are self-employed and that you are actively trading. So that way they know to expect a self-assessment from you. Now, the actual registration deadline for this is today. So if you are sort of on, if you haven't done the registration yet, I urge you to do this as quickly as possible before the close of play today. So we've got the link there. It's quite straightforward. You can even just Google, HMRC register for self-assessment if you want to, and that will take you through to the correct place. Now, one thing to be mindful of is you do get something called a UTR, which is a unique tax reference. This is personal to you. So if you're a limited company and you have, multiple directors, shareholders even, you will each get your own reference number. And of course, the same applies for sole traders. You'll get one for yourself as well. Now, you also need to be mindful that, again, going back to the whole making tax digital, HMRC are, I suppose, in some ways at last updating their systems, so no longer is it a rather archaic method of filling out paperwork and forms and things and sending it to them. You can sign up for a gateway account, and you can actually keep track of your personal tax on there as well. They do have, almost, for lack of a better term, almost like a two-step verification process. So they'll send you an activation code in the post, and at that point, you put that activation code into your online account and away you go. Okay. So yeah, do be mindful. Deadline for that is today. So absolutely make sure you jump at it when you get the chance to do so. If you are an existing Crunch client and you're on one of our paid for packages, we'd be happy to do that for you. So if you're not sure if you're registered or not, or perhaps when you joined us, you didn't ask us to help you with registration, get on the phone straight away, ask us to do it for you, and we'll get that sorted as quickly as we can. That's it from myself. Anything from either of you two about this particular subject?
Just on UTRs, if you are a limited company, just be very careful that you have the right UTR, because you have one for your corporation tax as well as your personal. And they're both 10 digits long, so it's really easy to get them mixed up. So just be extra careful, because you don't want to file with the wrong UTR number on there.
I wonder if there's anything in that for HMRC, if there's some sort of tactic of doing that on purpose. Let's make it the same. Let's make it the same length. Let's actually call it the same thing as well, and see how many people trip up over it. So it's a very, very good point. Limited companies do have their own company UTR, which is why I've added the additional personal UTR at 0.2. So yeah, just keep that in mind. So let us crack on then to some other differences. Now, I know we touched on this a moment ago towards the beginning of the presentation, but it's really, really important to understand what you actually need to report and what you might actually have to consider when you're doing self-assessments. So we touched on it earlier, PAYE. PAYE does not touch sole traders. Okay, PAYE is a monthly, as Michael said, it's called RTI. It's a monthly submission to HMRC where it's your pay slips. You also have things like P60s and P45s when you leave a job, for example. You also have P11D forms, which are benefits in kind. I won't chew your ears off about benefits in kind. We've got a ton of material about that if you are curious. And again, the difference really being the fact that limited can take dividends, whereas sole traders cannot. Now, in terms of what goes on the self-assessment, sole traders basically report everything. So every bit of business that you do, every sale that you make, every bit of money that you earn gets reported on the self-assessment. This is very different to that of a limited company, because as a limited company, your sales go through your business. Okay, so they'll be on things like your invoices and your company tax. Okay, so you do not put sales and invoices through on your self-assessment if you're a limited company. Okay, business income, not personal. The other very key difference is that you, as a limited company, file year-end accounts every year. And that's where the sales and invoices, profit and income is reported. So business side of things, they do year-end accounts for limited. But when it's a sole trader, you put everything down as a sole trader. So the last couple of points, as sole trader, you can't take PAYE. You don't do year-end accounts. It's a much simpler way of doing things. I have to admit, you just do one self-assessment each year, so your filing requirements and responsibilities are far less when compared to a limited company, but your self-assessments will include then sales, invoices, and of course your expenses as well. Anything further to that, Michael? I'm going to throw you under the bus slightly here.
No, nothing more to add here anyway. Yeah.
Perfect. Okay, cool. Okay, do we have any questions on this before moving on?
We've got a good one here, which just come in about claiming for working at home, which is quite a good one, because they are different depending if you're a sole trader or a limited company. So it might just be worth shining a light on that a little bit. Don't know if Michael, if you want to cover that.
Yeah, I think we've got bits of this one on the next 2 slides or so. So I think we could come back.
Apologies, I'm jumping ahead there.
That's okay. I'll move the slide on because it could be. We'll keep that one in the background then. So we'll go through what info you actually need to include on there to file it with HMRC. So again, if you have never done a self-assessment before and you've ever tried to navigate HMRC's website, you'll know how painful it is. Again, a lot could probably be said for how user-friendly they actually make the experience, but we won't go into that. So the key things that you need to make sure you have is that UTR number, so your personal UTR number. Okay, so 10-digit reference, that should be in the post. You should have a copy of that. If you're already registered and you've lost it, call HMRC and get them to reissue it to you. They'll send you another version in the post. You also need to make sure you have a national insurance number, because that will need to be included on your self-assessment. You'll need to include details of your undeclared income. So as we spoke about earlier, this is typically things like for sole traders, all of your sales, all of your business earnings. And for limited companies, it will be things like dividends. If you've got any, external income as well from shares, so if you earn interest off of shares, trying to think of another one for sole traders. I suppose actually going back to your point about rent, that also would need to be declared as external income as well. And this next point is super, super important, because this is the one that gives you those lovely tax relief benefits, and that's including your expenses. Expenses will reduce your profit, therefore it's deductible from the amount that you were due or expected to pay HMRC. So Michael, perhaps you could give us a working example maybe of how that works.
On the expenses, I need to clarify that they must be relevant to your business. So you can't go buy that sofa you like so much and then basically want to claim it as a business expense if you haven't got an external, let's say, premises where you need that sofa and that premises and the rest. So there are different types of expenses. They will be unique to each business, but there are some that are a bit common. So for example, accountancy fees, if you're a Crunch client, you basically will be getting invoices from us. That is going to be standard across board anyway for most clients. But some businesses might have some expenses that might be particular to them, whereas others might not have it in the rest. So it's one where we've got, I think, articles on business expenses. It's one there's an extensive list, but some may be applicable to some businesses and not other businesses, okay, depending on what they are actually doing. The guiding principle from HMRC's point of view is that business expenses need to be wholly and exclusively for business. Okay, so if you have expenses that are kind of part personal, part business, the starting point from HMRC's point of view is that no, you can't claim it. If you insist on claiming it, then you must be able to kind of make a clear distinction as to the business element of it and what is basically the personal element of it. So that is that's what we call dual purpose. So that expense has got two purposes anyway. So yeah, that's it on expenses, Ben.
Perfect. I suppose another thing as well, just on allowable expenses, is as you quite rightly said, is it wholly and exclusively for the business? Now, there can sometimes be some confusion with some items in particular. I think one of the most common one, Katie, Michael, correct me if I'm wrong, is clothing. I think we get that question quite a lot. And it's, you know, okay, I understand it. Everyone wants to look smart for their job. But again, going back to Michael's point of duality of purpose, if you buy that really nice suit, are you only going to wear that suit while you're working? Probably not. You know, there is a clear there's a clear path for you then to use it at personal events, you know, if you're going to a wedding or something like that. So there was a strange example that I was given a while ago, is if you were to buy a suit, Michael, tell me if I'm absolutely wrong, and I don't know if this is a myth or not. If you were to buy a suit and then put your company logo branded on that suit, technically, is that then deemed to be, you'd be able to claim for it? I mean, why you'd ruin a good suit with a logo, I don't know, but some people have asked it. So
depends how good your logo is, really, I suppose, doesn't it?
Very
you know,
true. Very, very true.
But yeah, you can't actually claim it, and the reason for it is that part of business is you've got to advertise your business. So just think about walking into Tesco's and you see people wearing Tesco. I mean, the employees are wearing. They are basically advertising or marketing the Tesco brand. Okay, so if you buy a good suit and then you basically put maybe Luke's Gym or Luke's the specialist instructor or whatever on there to advertise your business, that makes that whole suit plus, I mean, whatever cost you spent on branding it basically claimable. If, however, you haven't got any branding at all on it, then as you rightly said, you could take that suit to a wedding or basically take it for an interview. So, I mean, that then makes it for personal use anyway.
Okay, that's a very good point. I mean, I suppose the key thing when it comes to allowable is that you have to be able to evidence that it is for business purpose. And if there is an element of duality to it, you're going to have to be able to show that it is going to be used for business and business alone. I don't know. We're likely, when we get to this point as well, we always get a ton of questions regarding expenses. So I'll go through a handful of them very quickly that are deemed allowable business expenses. So, for instance, business mileage. So if you're using your own personal vehicle to travel to and from work, for example, you can claim business mileage. In terms of evidence for business mileage, there isn't really any. You know, because if for example you were a limited company and you had a company vehicle, so the car or van was bought under the company's name, you would claim fuel. So you'd actually be able to claim the full cost of petrol. You'd have receipts and things of that nature. When it comes to business mileage, though, you're not going to have receipts. You're not going to have evidence of that. So there is, in some scenarios, an element of trust when it comes down to claiming things like business mileage. Of course, the most effective way of being able to show any type of evidence is to document it or put it into a bookkeeping software. So you take the mileage allowance, you multiply it by the miles, pop it on a spreadsheet, add it to your software, whatever it is that you're using. That's typically the only form of evidence that you are going to have. I suppose another thing as well is laptops, so equipment, things like that. So I think all of us now in particular are going to have some sort of, device, whether it's a laptop, a desktop, or whatever it may be. Again, there can be an element of duality when it comes down to this. So for, traditionally speaking, if you were a limited company and you bought a piece of equipment, you would actually buy the equipment under the company's name. So you'd use the company's bank account. It then becomes an asset of the business. That's allowable, okay, because you bought it for the purpose of the business. Therefore, equipment is going to be allowable. Sole traders, of course, as well. So same applies. Laptops, if you're a tradesman and you buy tools, equipment to do the job, that again is going to be allowable, because without the tools to do the job, or even materials, you're not going to be able to perform your duties. So again, just keep that mindset of, is what I'm buying for the purpose of my business, or is there any element of it that I'm going to be able to benefit from personally? Okay. If you're in any doubts whatsoever, go onto our Crunch website. We've got some links at the end as well. So knowledge, help center articles, things of that nature, where it does cover this sort of thing. So again, I'm going to share all these presentation with you, so you've got those links on there. So anything further from you, perhaps, Katie?
Nothing to add from me. I'm just responding to a question at the moment.
Okay.
But yeah, I think you've got everything from what I can hear there.
Perfect. So moving on to the last couple of points then is charity contributions or pensions. Now, pensions is a very, very, first of all, it's a very good idea anyway. We should all be doing it. But a lot of people don't realize that pension actually does contribute towards getting tax relief. And it works slightly differently, I believe, between limited and sole traders. So I'm going to defer to Michael on this one, just to make sure this is absolutely correct. But it's quite a big tax relief, isn't it?
Yeah. For limited companies, there are 2 points of benefits for both the company and then the individual. So we'll come to the individual bit, but if a limited company was paying pensions on, let's just say, a director's behalf and the rest, they get to reduce their profits by that amount of pension they are paying. It's a tax deductible expense. So you can imagine, the allowance was raised from 40,000 to 60,000. So you can imagine paying that amount out, it would basically reduce your profit by a chunk. And then that's from the company's point of view. From the individual's point of view, the individual director's point of view, and then the sole trader as well, if they put money into a pension rest, what it basically does is that it increases their tax band. So for those who don't know, the taxes you pay is based on what brackets your income falls into. So let's just say that if someone was only earning, for argument's sake, around 12,000 a year, okay, they would have no tax to pay because that income falls below the personal allowance tax bracket. Okay, we're talking about income tax here. Mm-hmm. If that person was basically earning, let's just say, maybe 40,000, you take off the personal allowance, which is, let's just say, the 12,570 out of it. The difference they then pay 20% tax on. Okay, and that 20% tax bracket is up to 50,270. So when your income goes above the 5270, that's when you start paying tax at 40%. Now, what pensions, and also to add, gift aid, or let's say money to charities, basically does is that they push your tax band or the tax brackets up. So the 5270 threshold moves up by the percentage or the amount of money put into a pension. There's a working for it, which is a bit complicated anyway. But that is the effect of paying into a pension or into charity. It pushes your tax band up, so you have more income being taxed at the 20% than at the 40%. Okay.
Gotcha.
So imagine the two of us were on the same income. Okay. You didn't give money to charity or pay into a pension. Okay. And then let's just say that you had 20,000 being taxed under the 40%. and I was basically putting money into charity and the rest, I might have, let's just say, because of the amount I've contributed into a pension or charity, I might rather have, let's say, maybe 10,000 or 15,000 being taxed under the 40% because of the movement of the tax band for me compared to you.
Gotcha.
Does that make sense?
Yeah. I also, going back to your point earlier about the allowances that everybody is entitled to, it's probably worth making a distinction between the PAYE allowance and the national insurance allowance, because that is something else that actually not a lot of people do know about. I mean, there could be an argument again for why aren't we taught these sort of things in school, but I think that's an age-old argument that's been going on for some time. And the difference really is that everyone effectively has a national insurance threshold. So it's a certain amount that everybody can earn tax-free before you start paying NI contributions and income tax as well. Now, that, I think, correct me if I'm wrong, I'm just going to ballpark at the moment. I think it's about 8,000, or is it 9,000 now? It's 9,100-ish, is it? The national insurance?
Yes, what you're referring to is the secondary NI threshold, which is 9,100. And that is where the employer pays, national insurance contributions on behalf of the employee. So there are two different thresholds. There's one called a primary NI threshold, and then there's a secondary NI threshold. The primary NI threshold is where the employee pays NI. So I think at the moment it's still, they've pegged up the primary NI threshold to your personal allowance threshold. There used to be a massive gap. So you could have someone basically earning the 12,570, they wouldn't pay any income tax, but then they would have NI being deducted from their pay slips. Okay, the government closed that gap by increasing that. But what they've done is that they've still kept the secondary NI threshold, which is the one at the threshold that the employer pays NI for the employee, still low. That is why we sometimes recommend that you take salary up to the secondary NI threshold, and the difference you then take up in dividends. But that is under class 1 NI contributions, and that only happens through PAYE. You don't have that NI being deducted when you're filing self-assessment. When you're filing self-assessment, the only NI deducted in there is linked to sole trade income, which is class 2 and class 4 NI. Okay, so assuming an employee hasn't paid enough NI through employment, it doesn't mean that when they file their self-assessment, they will then have their class 1 NI being deducted. That doesn't happen. Okay, it's only on the sole trade income.
Got you. Awesome. Okay, yeah, that's good to know. Because there, like I say, there can be a lot of confusion between those different taxes and their thresholds. So I think, our general advice for limited companies will always be take a low salary below your national insurance threshold. And like Michael's quite rightly said, you actually make up the rest of it in dividends, because the tax rate on dividends compared to income tax is considerably lower than what you would pay on a salary. If you were to take, up to 30 grand as a salary, you'd pay way more tax on that than you would if you took 30 grand, let's say, in dividends instead. So that's one thing to bear in mind as well, for limiteds to be tax efficient. In that case, for sole traders, I guess the important thing in tax efficiency is probably mostly going to be things like expenses, isn't it? So it's just ensuring that you're claiming absolutely everything that you can, which, going back to the point earlier of if you've got tools, materials, that sort of stuff, absolutely make sure that you're claiming all of that to get the most tax relief from your self-assessment as you possibly can. Cool. I think then we've more or less covered what should be included on there. I mean, there are, of course, more complex things like that. That's it in a nutshell, for lack of a better phrase. But things do get a little bit more complicated when you start having niche sources of income, so shares in other businesses, if you've got investments or loans, that type of stuff, it can get a bit daunting. But again, we're here on hand. If you do need to call us, absolutely do. If you want to jump onto our knowledge websites, there's tons of materials on there that should have you completely covered for those types of scenarios. Moving on then to how you actually prepare it. Now, some of this we've probably already covered during this discussion anyway, but it can't be understated how important this stuff is. So as mentioned, we'll start with income. So the two key differences to be mindful of is a director, so a limited company, does not include income from invoices on their self-assessment. You would just typically look at your personal earnings from that company or from external sources. You could be a limited company, but actually you're a landlord on the side. That all needs to be put, your personal earnings. So you're taking salary and dividends from the limited company, plus you're earning externally through rent. That needs to go on your self-assessment, but you don't put company invoices on the self-assessment. Sole trader is very different. Sole trader, you pretty much include everything. So every penny that you are earning under your trade does go onto your self-assessment instead. Expenses, we touched on just a moment ago. It's super, super important to make sure you're claiming what you can to get that tax relief and reduce your tax bill. Going back to Michael's point about wholly and solely for business purposes, always keep that in your mind. So if you are wondering, can I claim this? Can't I claim this? Just have a sit back and think, is there any bit of this that I could use personally? Majority of the time, it's going to be a no if there is any element of personal use, which again goes back to that third point of duality of purpose as well. Now, Michael has very kindly put some figures and some excellent points here about mileage. Again, further info about pensions. So I'm going to hand over to Michael for this one to discuss your tax efficiency and how you can do it the right way.
Yeah, thanks, Luke. Yeah, this goes to some of the question that I think Katie was asking, or which one of the participants basically asked in terms of what they could claim. So self-assessments, most people work from home nowadays due to COVID and the rest, so it's become a norm in our society now. There is £6 a week you can claim if you're working from home. So on average, it comes to around £312 a year. You could basically include that in your claim anyway. So for those who are, let's say, limited company directors working from home, yeah, you could claim that. Or even if you are an employee filing a self-assessment, you could also include that. The crucial thing is that if your employer hasn't reimbursed you for it, then that is when you can make the claim. But if you've already been reimbursed, then there is no point including it, because it's like having two bites of the same cake anyway. Okay. For sole traders as well, there is a flat rate amount you can claim, which is either going to be 10, 18 or 26 pounds per month, depending on how many hours you work. The slides, when we send it to you, have got links in there, so you can see it from HMRC's website anyway. Depends on whether you work between, let's say, 25 to 50 hours or about 50 hours or so a month anyway. Yeah, so that is also in there. We've already talked about pensions, basically offering tax relief. In terms of the business mileage, look, you talked about that one as well. If you are using your personal vehicle for work, yes, you should make that claim. Fine, you might be putting fuel in there and going for your personal functions, and then also using it for work. But what you should do is that you should have a log. I know, look, you're saying that's it's a bit difficult to have evidence and the rest, but you should keep a log. Ideally, we've got spreadsheets where, for recording business mileage, dates, place you went to, how many miles you covered, and then obviously the return and the rest. What you should know is that these things can be presented to HMRC as some form of evidence okay, in case they ever want to investigate you. And what we shouldn't also forget is that HMRC have got the powers to basically speak to whoever basically employs you or engages you to basically check. And then, I mean, if you claim that you've made this trip on this date and arrest, do we have any evidence from a third party to back this up or not? So under the investigatory powers that HMRC have got, they can actually speak to anyone they want to confirm what information they have been supplied with. So be careful with what you basically put down. But you obviously do get 45p per mile up to 10,000 and then 25p per mile after. There is also the ability to make voluntary class 2 NI contributions. And this we would recommend for those who don't have any PAYE income above the 9,100 or the secondary NI threshold. The reason for making a voluntary contribution is that it also counts towards your state's pension entitlement. Okay, so if you're a sole trader and that is your main source of income, and let's just say that you haven't got enough profit, so you don't have to pay any NI contributions, ideally you would want to pay that £163 or so, just so that tax year would also qualify towards your state pension entitlement. Okay.
Okay. Perfect. Some really, really good tax efficiency gains there as well. Katie, do you have any questions that we can display on screen? Again, this is...
we have got plenty coming. A lot of them are quite specific to individuals. We have one asking about claiming using the complex method for working from home, so working out percentage of your bills versus the space and the time. Just to say you can do that if you're a limited company. We do have a calculator that you can use to help you work out that specific amount. It's worth having a look at both because you can sometimes end up claiming for more. But yeah, that's more for limited companies rather than for sole traders. Just to
sole traders can also do that as well.
I thought it was only limited. That's good to know.
No, sole traders can also do that as well, because you could obviously have a sole trader who probably, let's just say you've opened up your salon or whatever in your garage and the rest, you are using a bigger space and the rest. So sole traders can do that. The only caveat for limited companies is that usually we ask that they have a contract or a rental agreement between the company and then the individual, because what happens is that if you are claiming that you are getting a bigger proportion, then technically it's more like a rental income and the rest, and you want to be okay when HMRC basically knocks on your door. So that's the only thing, but sole traders can also claim that.
It's very good to know. That is very, very good to know. I was also under the impression that it was predominantly for limited, so that's very, very handy tip. Very handy. I have seen a question here. We'll quickly answer this last one because I think this has come up a few times about if you're a sole trader and you issue an invoice in one tax year. Let me put the question up. Actually, this is from Christina. So as a sole trader, if you issue an invoice in one tax year, say the 4th of April 23, but it's paid and income is received 30 days later, 4th of May, what tax year do you claim it in?
Okay, this is a fantastic question, and it goes to the basis under which your self-assessment has been prepared. So self-assessments can be prepared one of two ways. There's one we call the traditional method or the accruals concept, and there's the cash basis. At Crunch, what we usually prefer to do is the cash basis. But the accrual basis simply means that when you issue an invoice, okay, that income has been recognized and basically goes onto your self-assessment. Okay. At Crunch, we prefer the cash basis because you are recognizing income when the money actually hits your bank account. So imagine you raise the invoice in this tax year and then it goes onto your self-assessment. You are expecting it in 30 days in the next tax year. Then your client, for whatever reason, drops off this earth or whatever, you don't get any money from them. You have already paid taxes to HMRC, and then basically your client hasn't paid you. Now you've got to go through the whole issue of trying to basically recording that as a bad debt. And then so at Crunch, that's why we prefer the cash basis, because you only record income when it hits your bank account. Okay.
That makes a lot of sense. And actually, it's probably the better way of doing things, as you've quite rightly said, because then you're only paying for, you're only paying tax on the things that you've actually received, rather than in some, on an accrual basis, hypothetically, I've invoiced for this amount, but, like Michael said, if you end up in a dispute and then you haven't been paid for the work, or they just take ages paying you for the work, you're not then paying for something that you quite simply haven't even received yet yourself. So yeah, hopefully that answers your question, Christina. And I know that there were some others that were curious about that as well. But yes, for Crunch, we will always go cash basis, because we feel like that's the better way of doing things, and it's also the fairer way of doing things as well. Okie dokie. I think then we're coming up to time now, so I'll quickly finish off the last slide or two. So one thing to bear in mind, that if you are a paying Crunch member or a Crunch free member, it makes absolutely no difference. If you do want us to help you with your self-assessment, the great thing about using our bookkeeping software and keeping your account up to date is that actually most of that information is going to be pulled onto the self-assessment for you automatically. There's only really a handful of questions, I'd say maybe even a few, that you might need to go and have a look at yourself. So things like personal banking interest is one of them, I believe, isn't it, Michael? And perhaps things like, if you are in this scenario where you're a limited company, but you're also a private landlord, that's also something you're going to have to fish out yourself and add that to your self-assessment. But for the most part, as long as your account's up to date, you start the questionnaire in Crunch, things like your salary, your dividends, your earnings, if you're a sole trader, that's all going to be put nice and neatly into the self-assessment for you. So the reality of it is, all you then need to do is basically a tick box exercise. It's just go through, make sure that the figures are correct and that it's pulled the correct data in. Likewise with expenses as well, make sure that you've got everything in your account first before you start doing self-assessment, and all of that data will come through as well. The other thing worth bearing in mind as well is that while and if you get Crunch to do your self-assessment, Michael and his team will actually review this for you. It's not just, oh, okay, you've submitted your self-assessment, away it goes. Okay. We do thorough checks of your self-assessment. We review all of them before we file them with HMRC. And if there's anything actually that you've missed, so perhaps use of home as a prime example, we will actually tell you to include it before that submission goes ahead. We will always have discussions with you about it. So, have you claimed for this? Have you thought about doing this? Are you happy with this self-assessment as well? Okay, so this applies to everybody, as I say. So if you're a paid member, you've got unlimited support from us. Crunch fee members, if you do want to discuss, you can actually book in time with an accountant. And actually, even if you're neither, so we do offer a completely one-off service that you can do this as a standalone. Now, one thing that I believe is worth mentioning, I know we're slightly overrunning, but I do think this is worthwhile highlighting, is when you come to pay your tax to HMRC. So let's say you've got, I don't know, let's say as a ballpark figure, you owe HMRC £3,000, something like that. Payment on account, it's a dreaded topic, and one that is overly complicated, but actually we try and sort of demystify it and uncomplicate it as best we can in a way that hopefully you'll all feel relatively comfortable with. Now, payment on account is another one of those mechanics that HMRC have introduced. It's not an old mechanic. It's relatively new in the grand scheme of things. But this is essentially, correct me if I'm wrong, Michael, but I see this almost like credit. So you owe HMRC £3,000 for a self-assessment. They actually then want another £3,000 as credit, which is the payment on account, towards your next self-assessment. It's a really painful thing to go through, especially when you don't expect it. You're expecting a tax bill of £3,000. All of a sudden, HMRC wants 6, and you're sat there like, well, where the heck has this come from? I don't know where I'm going to get this money. Michael, I will defer to you because I know that this is probably something you deal with almost every day, I would imagine, if not every other day. So perhaps you can break that down for us.
Yeah, you are right on the way you summarized it anyway. So HMRC is expecting the 3, but you end up paying 6 anyway. The caveat for it is that you don't need to make the payments on account if you don't want to make it, okay? However, the payments on account is supposed to, let's say, pay towards your next tax bill. So if your tax bill comes to what HMRC expected it to be, and then you don't make that payment on account, what they will do is charge you interest. Okay. So although
Of
they
course
say
they will.
basically
There are
although
traps
they say
everywhere. It's
Yeah.
terrible.
so although they say you don't have to make the payments in accounts, they do charge you interest for it. So going with your 3,000 scenario, so let's just assume that you've done your 22-23 tax year. Your actual bill for this tax year is only 3,000. You are supposed to pay that 3,000 by 31st of January next year. Okay, that 3,000 that you're supposed to pay, they will then add 1/2 of another 3,000 towards. So that's 1,500 towards. So what they'll be expecting is that you pay 4,500 in January. Okay, so that's your 3,000 pound bill plus 1,500, and then the following July you then pay an extra 1,500. So in total you end up paying the 6,000. What then happens is that when you file your self-assessment for the next tax year, which is 23-24, they would then reduce your tax bill. So let's just assume that your tax bill was for that tax year is 2,000. They would then take that 3,000 off the 2,000. And then in this case, because the amount you paid is far greater than what your tax bill is, you'll be due a rebate from HMRC for £1,000. But assuming that your tax bill was basically 4,000, then in this case, they will take the 3,000 off. Then you have to pay HMRC the difference of £1,000 for your 23-24 one. But let's not forget that the payments on account is a cycle. So although you would only pay £1,000 towards your 23-24, because your tax bill for 23-24 was 4,000, there's going to be another payment on account for the following tax year, which is going to be, let's say, an extra 2,000 as well. So yeah, it's a cycle that keeps going on. The only time payments on account stops is when maybe you stop earning, or maybe you're giving up, you're migrating or something of that sort, or you're not going to earn anymore. That's when you can basically stop it. But I must also say it's not mandatory, but then they will charge you interest if you decide you don't want to make the payments on account.
So I think Les has put it quite rightly. Scandalous, I think, is probably the apt word for it, to be honest. I mean, I think, going back to your point, after a while, yes, it becomes this sort of revolving door of cash for HMRC, doesn't it? And in some ways, you probably just end up getting used to it. But I think the ones that are hard hit the most is when you start. It's that first initial payment on account, isn't it? That's the one that really catches people out, because, like you said, you're expecting £3,000. All of a sudden, they now want £4,500. Plus, then they want another 1,500 quid in July as well, all within the same year. So, budgeting, taking that into account, making sure you've put a bit of cash aside for that scenario is going to be critical. So it's very, very important that you understand this.
I think one quick point to add to that is that's for this reason why it's important that people need to file their self-assessments early. Because what you can then do is that, assuming you filed your self-assessment, I mean, the tax year ends 5th of April. So from the 6th of April, you can immediately file your self-assessment if you have the next all the information. And then you can start maybe making payments, because you have to pay by 31st of January. So assuming I know my tax bill is, let's just say, I don't know, 12,000 or whatever, I could probably start paying 1,000 maybe on a monthly basis or something, so that it's like you're spreading the payment. So that's one advantage of filing your self-assessments early, because you get to budget and then spread your payments as well.
Yeah, well, I again, it's one of those things where I know, all three of us here have experienced it. There's, typically you're either someone that gets it in the door, you get it done, you get it out the way, and then you've got effectively 9 months before the due date, then you know, if you did it in April or even May, you've got plenty of time. Or you're somebody, and I'll admit it, somebody like me who leaves everything till the last minute, and that's when, you know, I end up in these tricky scenarios as well. So it's always better just, you know, once the tax year is done, get your ducks in a row, get your self-assessment out of the way. That will give you plenty of time then for any nasty surprises to be dealt with, and you're not in that last minute rush. In terms of who a payment on account applies to, I believe it's the same whether you're sole trader or limited. There's no differentiation there.
No
and it's cool. And it's also if you've earned, or you owe, sorry, if you owe HMRC more than £1,000 in tax, that's when a payment on account applies. But if it's less than £1,000 owed in tax, it won't apply. Is that right?
Yeah, you're right.
Cool. Perfect. So yeah, just I didn't want to forget that. I know it's something that a lot of people question, and again, like I said, it does trip up a lot of people, unfortunately. Like Katie quite rightly said, there's a lot of traps and pitfalls when it comes to HMRC. You know, if there's a space for a hole for them to dig, they will do it. So just keep that in mind. You know, always double check, get things done early, make sure you've got everything that you can in order, so you avoid any of those horrible, or as Les says, scandalous experiences with HMRC. So I believe that is it now from us. That's everything from, you know, what is a self-assessment to registering for it, the differences between limited and sole trader, the key tax efficiency gains that everybody here should be mindful of, allowable expenses, things like duality of purpose, payment on account. We've covered quite a lot. And I do want to thank you all for your time today and your patience. I know we've run over slightly, but I do hope that you found this invaluable and helpful in getting you prepared for your self-assessment ahead of time. Do not forget about the registration deadline today. Please keep on top of that. You know, as I probably don't need to say it, but if you don't do it in time, HMRC will be charging interest, I'd imagine, or late filing penalties and things, and that's just stuff you absolutely don't want. And do not forget about the deadline, the 31st of January. That is the absolute latest that you can get it filed. If you haven't already, please prepare yourselves and get your stuff sorted. And like I said, any support, any help at all, give us a ring, jump onto those links there that I've got on screen now. But I do wish you all the very, very best of luck getting yourself prepared and ready for self-assessment, and have a fantastic Halloween season as well. So goodbye from myself. I will hand over to Katie to sign off, and then Michael.
Yeah, thanks so much everyone for attending. Thank you so much for all your questions that you've asked as well. Apologies we couldn't get through all of them. There's tons on there. We will do our best to put together like an FAQ or something to send out with the slides to try and cover as much as we can. But yeah, I hope you found it useful, and I hope you join us again for our next one, whenever that happens to be. End of tax year, most likely.
Yes, it will be end of tax year.
Cool.
Yeah.
Thanks
everyone.
All
And
right.
thanks, Luke and Katie.
You're very welcome. So yeah, for everyone else, I will be putting together an email, so I'll follow this up with you all. So you'll have the slide deck. I will also send you the recording as well. So I'm going to get onto that straight away, and I'll get that over to you as quickly as I possibly can. But yeah, a massive thank you once again, and have a fantastic rest of your day. Take care, everyone.
Bye.
Bye.